Hey, thanks for joining us today in another Ultimate Edge webinar series, this time with John McKeon of McKeon Financial. Hi, John. How are you?
I'm good, John. Glad to be here.
Thank you for joining us. For compliance purposes, first of all, guys, I want to share some compliance slides that John would like. Actually, John's compliance people would like. Today, we're going to have a chat about wealth building. It's going to be mostly Q&A with John McKeon, who's a registered principal at McKeon Financial. I'm going to allow John to share a little more about his background because it's very interesting once we get through the compliance slides. And there's our disclaimer. Do I need to read that, John, or is popping it up there good enough?
Probably good enough. Yeah, can't guarantee everything is accurate or complete. Strategies may or may not be suitable for all individuals. Any examples are for illustrative purposes only. Educational and not recommendation for any specific individual. And my broker-dealer is Independent Financial Group, and I think that's good enough.
Very good. We want to be compliant. That is important, both in the mortgage industry and in the financial services industry. So we're back. So John, before we dive in here and talk about off-market strategies for investments, I would like to get a little bit about your background. Now, I know a fair amount about it. John and I used to share an office together. He was kind enough back in 2008 when I was moving things around, trying to survive, to let me plant a branch in his office. So we got to know each other really well. And then I moved out and onward, and here we are again. So John, you're from a naval background and all that. Can you share a little bit about your background and what brought you into the financial services arena, please?
Wow. So how far back do you want to go?
Well, just a couple minutes is all we need because we want to get in the meat here pretty quick.
Alrighty. Well, I noticed that you have some affiliations. Well, I knew you always had affiliations with Hawaii itself.
Yeah.
So I did grow up in Hawaii. My mom is from the islands, and you can't tell, but I'm a third Hawaiian, Chinese, and some other things as well, but half Irish and throw in some German and English and so forth. I graduated from Hawaii from Punahou School in 1983. I did pick pineapples for a couple summers on Lanai when they had pineapples. Had a year at School of Iowa. At Iowa State. I graduated from the U.S. Naval Academy in 1988, Bachelor of Science in Mathematics, master's degree from Penn State with nuclear engineering. Did a bunch of training and served on USS Olympia, which is a submarine out of Pearl Harbor. And we were stationed in Pearl Harbor from 1991 to 1996. But I graduated in 88. In 89, the Berlin Wall came down. And through the mid-90s, there was a massive downsizing in the military. So I made the obvious career transition from Navy nuclear submarine warfare officer to insurance sales guy. And we moved from Hawaii to here in Washington State in the Arlington-Marysville area. For those who are unfamiliar, it's an hour north of Seattle. But came out in the summer of 1996. The obvious career transition into insurance, which was not obvious at all. But specialized in long-term care insurance, which was half medical underwriting and half retirement income planning against long-term care needs. And by the early 2000s, had about 1,000 insurance clients. Wow. But in 2002, the year after 9/11, I had 300 appointments that year and a couple thousand phone calls. And the average client that I met with was in their 50s, 60s, or 70s. The average client that I met with had lost a third of their investments. And the average client that I met with, 90% of the time was a combination of stocks, bonds, or stock and bond mutual funds. And maybe it's 50-50 or 60-40 or 70-30 in the split. But that's what retirement planning was for pretty much everybody I met with. And when we opened our office in 2004, the idea was not to compete with Edward Jones, Merrill Lynch, Smith Barney, Fidelity, Vanguard, TD Ameritrade. They will all do a better job than little old McKeon Financial in what they specialize in, which is stocks and bonds and market-based investments. What we decided instead we're licensed for everything. First of all, we're insurance licensed for insurance and disability, for health and disability. We're securities licensed for everything, Series 7, 66, etc. We can do stocks and bonds. They're actually easy. But the much harder one that 99% of financial advisors do not do, and the public can't do on their own, is in the big world of alternative investments. Mm-hmm. And studying, if you study big money, like insurance companies, pension funds, endowments, what they do not do just 50-50 of stocks and bonds. They'll buy real estate, they'll buy oil and gas royalties, they'll do a lot of other things. They'll do hedge funds, etc. So when we opened the office, the idea wasn't that the stock and bond market was bad or evil. It was the only game in town for most retirees. What we wanted to do was be able to offer similar investments for our clients that the big money was doing. So big money, they might have a $1 to $10 million minimum in an institutional fund. We have investments with $2,500 minimums or $5,000 minimums, etc. That a much broader part of the population can be invested in. So that's what started a journey many, many years ago, and it's evolved quite a bit since then as products change and so forth.
All right, so not all of your investors are accredited investors then, is that correct, John?
That is correct. We have some investments that are just for accredited investors. What's the definition of accredited?
Let's do that, please.
Accredited investor is somebody with a net worth of $1 million or more, separate from their principal residence. So they could have stocks, bonds, mutual funds, money in the bank, a 401k, an IRA. They could have investment real estate. But those types of things outside of their principal residence, if it's $1 million or more, they're accredited. But we also have investments that are what we call 70-70-250. And 70-70-250 is income of 70,000 or more with investments of 70,000 or investments of 250,000. And that opens up additional investments like a non-stock market traded REIT or BDC, business development company, or other alternative investments that don't require full accreditation.
Okay.
And we have others that don't have any income or asset requirements. But that's always been our goal, was how can our clients, just normal people, half of our clients are accredited, half are not.
Okay. How
can our clients who are not trizillionaires invest like those who have, many million-dollar portfolios? And how can we do that with investments that would be suitable and appropriate for them and for their needs? And our broker-dealer independent financial group plays a very nice role. They're in San Diego. They serve as our compliance, our supervision. Due diligence has to approve every investment that we work with. So there's a lot of stuff out there. Fortunately, they weed out a lot of that. So we'll have investments that are not in the stock market. We'll have investments that are only a little bit in the stock market. We'll have investments that have very little correlation in the stock market. Even those that are in the stock market, very low correlation. So that's our specialty. We are able to do a lot of that in an advisory account today. So that everything, and for us, an advisory account is a fiduciary account. It's an actively managed account, fiduciary client best interest requirement. But everything in that advisory account must be liquid daily, monthly, or quarterly. And we can actually put a lot of alternative investments into that category today that we couldn't 5 or 10 years ago with product changes and improvements. We have other products, other stuff that can't fit in the advisory model that are buy and hold for 5 to 10 years. That includes, for instance, our DSTs, our Delaware Statutory Trust investments, So that's what we use in a 1031 tax deferred exchange as one of the investment options in the exchange. But because I don't have ready liquidity on that, that has to be in the commission side of our business. So we're a hybrid firm. We're able to do commission products as well as advisory products. And we do that all through our broker-dealer independent financial group.
Phew, you covered a lot of ground there, John.
Phew.
I'm telling you.
All right.
All right. Separate out advisory versus commission. What does that mean to people in terms of what they pay and how they pay and all of that?
Okay. So advisory, a lot of people heard the word fiduciary. Fiduciary is client best interest. It's the highest level of requirement on our end. The bottom line is, if you don't have your client's best interest in mind, you shouldn't be in the business anyway. But because you're paid the same from the account, no matter what the investment is, technically you're not incentivized to favor one investment over another,
Okay.
as somebody might be in the commission world. You know, whether they get an upfront commission or some other arrangement. But it's very regulated. And on the advisory side, our normal advisory fee is 1% a year.
Okay.
On our actively managed accounts. And that's normally 0.25% each quarter. The custodian of the account will charge a little bit more. So it'll be slightly over 0.25% for total fees, but that comes out of the account. And we'll have a number of investments in that account, which can include real estate investments and others, other alternatives, plus stocks, bonds, whatever we choose to invest in that. But we do not do a 60-40 split of stocks and bonds. We have a lot of alternatives, which is a big part of our conversation. On the commission side, FINRA makes sure that over the long haul, you're not making more commission than if the monies were in an advisory account. So for instance, a Delaware statutory trust is an investment in a 1031 exchange. Somebody who has investment real estate could invest for sell it, do a 1031 exchange, and purchase other investment real estate. So they could sell a condo and buy a condo. They could sell an office building. They could sell farmland, raw land, a retail building, and they can buy any of the above that we just described. But if they're accredited, one of their choices is a fractional ownership in a Delaware statutory trust investment. And that qualifies in the 1031 exchange because they're owning a part of the underlying real estate. Rather than shares of a non-traded REIT or shares of a limited partnership or LLC, if it was a $100 million apartment complex in a Delaware statutory trust, and they bought $1 million of that, they would be a 1% owner. So that's the reason it qualifies in the 1031 exchange. They're actually a fractional owner of the real estate. But it's a commission investment. It has very little liquidity over the average lifespan of 6 to 9 years. The commission that the company that we're doing business with pays me is 6%, but that's 6% one time for that 6 to 9 year time frame. So it's typically over the long haul less than in an advisory account, but the advisory is an actively managed account that we could sell things if we needed to, or sell it all in a short period of time. That would be a buy and hold until the DST company decides to sell that investment. So that's the difference between the commission and the advisory. There's very strict rules. You can't mix the two together. And but we're able to work in a wide range of alternative investments that I can put into an advisory account, or if I can't put an advisory account, I can still manage that transaction very easily.
All right. And Don, can you talk about yields on this particular call? And do they vary according, are they kind of the same? And for the smaller investor, can they get about the same yield on those as opposed to the accredited one and the larger pools? And can you chat about that a little bit?
Yes. Past performance is not indicative of future returns. Please read the prospectus for full information. And we're not actually talking about specific product, but I think the in general part is this. The majority of our clients, as I said, half are accredited, half are not.
Okay.
We have investments for anybody. I think the big difference with accredited investments in the alternative world is what makes them accredited is often their lack of liquidity. Maybe more risk. It's a smaller offering. Maybe they're only raising $50 or $100 million. It's a illiquid fund for the next 5 to 10 years, maybe longer. That has all of the makings of an accredited offering, somebody who is more able to take on that risk in general, maybe somebody who has a lot more liquid assets as well. That's the same with the DST, a pretty illiquid investment. So when it's illiquid, when it's an accredited investment, often the yield expectation would be a bit higher. You're taking on that liquidity risk for some hope for greater return, but you also have more risk. What if you don't get the money back? What if it takes a lot longer to fully cycle that investment? But in general, greater risk, in this case, typically less liquidity, maybe more investment risk, hopefully a better return. What does that look like? Again, hopefully, that might be an 8% or better return year over year. Hopefully, could be a lot more, could be a lot less.
That's pretty broad, John.
I'm trying to call it as broad as I can. On the DSTs, our hope for is a 6 to 10% a year return or better, which is both income and appreciation.
Okay.
If income is, let's say averaging 4% a year on a DST, maybe increasing to 5% a year. With appreciation, if your minimum for a DST is $100,000, if you're selling an investment property, that could be many hundreds of thousands of dollars. So the DST is useful to pick up the leftovers in a 1031 exchange. It's useful to be the backup in a 1031 exchange. It's also very useful to be the 1031 exchange, somebody who is getting out of actively managing their own real estate and would like to have somebody else do it all. But if their income over the next 6 to 8 years was averaging 4% a year, then the hope would be, for instance, another 5% a year of appreciation, so that their $100,000 DST purchase would be, for instance, $130,000 in 6 years. So it's not something that will double your money in 5 years or 10 years, but it's something to not lose your money, to have incremental growth each year, to have income every month, and a tremendous amount of tax breaks. Because people who do 1031 exchanges could save 20 to 40% in taxes by doing the exchange.
Right.
Particularly if the property is in a high tax state like Hawaii or California. So it's very useful for that. That is a commission account, a longer term. That is an accredited offering. We do have some other accredited offerings that aren't tied to a 1031. And we have a lot. What's changed in the last 5 and 10 years is we have a lot of investments that now fit the mold of an advisory account. If we're rolling over an IRA or 401k, if somebody sold their business and there's some extra money available, if they've inherited some money and they've already have a great account with their stockbroker or their, financial planner, but they wanted to diversify that, so they didn't want to be all in stocks and bonds, then we can easily do that in an advisory account today, where we didn't have that option before, because of the product evolution over time has become more liquid, more transparent, more malleable, so that we're not just buying an investment and stuck with it for 5 or 10 years. We can buy it and evaluate it and keep or pass it up.
John, for our real estate clients, because we obviously do mortgages, we have a lot of real estate investors on the Delaware Statutory Trust. Do they get income on that in that 4% range on a monthly, quarterly, annual basis, or how does that work? And then how do they realize their equity appreciation eventually?
So there's a highly technical term when referring to 1031 exchanges. If a person is going down that road, exchanging their investment property for other investment property, we call it swap to drop. If you want to write that down, it's swap to drop. You want to continue to kick that tax can down the road, because there could be a lot of built up capital gain and depreciation recapture in a 1031 exchange.
Right.
You want to, if possible, you want to exchange all the equity for an equal or higher amount of exchange debt. For instance, if you just have $1 million of equity, there's no debt. You would want to exchange it for $1 million of equity and whatever amount of debt you want. If you had, if your $1 million was 700,000 of equity and with 300,000 of debt, you'd want to exchange the 700,000 of equity with 300,000 or more of debt. So that's important to cover. I am forgetting the initial question though. So what was it again?
How do they get paid? Do they get monthly installments? Do they get quarterly? And then how do they realize their equity eventually? Do they do another 1031 in 5 years, or and do they get taxed at that time if they pull it out? All of the intricacies around that.
Perfect. Got it. Thank you for the assist. So DSTs today have been pretty conservative. Well, they've always been conservative. They've always cash flowing. 80+% of the ones I see are investment apartments, so multifamily apartment complexes. Many of them are single property, so a 200 to 400 unit, a newer or brand new apartment complex. Most of the time in the Southeast, you can have more than one property in a 1031 exchange, but I tend to prefer the single properties. Outside of that, some of them are distribution centers, like an Amazon distribution center, for instance. Income is typically monthly. It's typically increasing over the life that you hold the DST. A few years ago, the income was higher at the 4 to 5% starting point. Today, on average, it's in the 3.5 to 4% starting point for income. That's paid monthly. That hopefully should increase to 4 to 5% over the life of the hold. When they sell the property, again, hopefully they're selling it with appreciated value. So if they, for instance, bought their $100,000 DST, hopefully in 5, 6, 7, 8 years, they're selling it for 110 or 20 or 30 or more. At that time, most people will swap till they drop. They will roll into another 1031 exchange, whether or not that's a DST. They can also buy other real estate if they chose to.
Okay.
But it's good if one person passes away, basis steps up. In a community property, all basis steps up. In a non-community property state, at least half of the basis will step up. So you want to preferably do 1031s until somebody dies.
Right.
And then evaluate, do we get out at that point?
Right.
And for a DST, it's best to wait until they sell. So it might be another year or two later or 3 years later. But when they sell at that point, if the decision is to get out with little to no taxes being paid, then to get out of that trade, receive the money in cash and do other things with it at that point.
Okay. We're kind of winding down, but I got a couple of questions I want to ask you, John. So we try to keep it within the time frame we have here. Question number one: Who is your optimum client? What profile would fit that if they wanted to come to McKeon Financial and invest, John?
Optimum client. We've kept ourselves. The DST is a part of what we do. It's not the only thing we do. We've got a lot of expertise through the years, so it's fairly easy for us. But we're more than happy to work on the advisory side with a 401k rollover or an IRA. I think while we'll look at smaller accounts, I think our ideal client would be somebody that we have the ability to work with $200,000 or more of investable assets, whether that be on the commission side like a DST or other investment, or on the advisory side, or somebody that we could build to that account size or more. There's just so much that we can do today that we couldn't do 5-10 years ago. And it's exciting to be able to do that on the advisory side as well, because we just have a lot more liquidity, a lot more transparency, and so forth. But so $200,000 or more of investable assets preferred. Somebody who will listen. That's always good. We like to educate. We'll educate all day long. I'm not interested in having somebody purchase something that they'll feel uncomfortable with later. So especially if it's a long-term investment, I really want to hit that hard. And, I'd rather convince somebody not to buy something if it's not appropriate for them than to, life is short. We want to have clients that are very happy. But our ideal client is somebody who would like to consider alternatives to the, quote unquote, normal stuff. What's nice about the alternatives tend to be less volatility, more steadiness. You'd ask right off the front, what's our goal? Our typical account, we'd like to not lose people money as much as we can.
I think that's a very good goal. Yeah.
We have the ability to generate higher income than a lot of other accounts because we have a lot of investments focused on that. But net of any fees or net of any commissions, our desire is to, if we can generate 6 to 10% a year, net of any fees, commissions, etc., and do that with as little volatility as possible, that's our goal. And if somebody is open-minded, if they would listen, if they're nice to my staff, they could be a very good client for us.
Okay, so you prefer they have a couple $100,000 to invest. Age is not necessarily a factor here. It's just somebody who's seeking stability, it sounds like, and safety, kind of not the volatility of the stock market. Is that correct, John?
That's correct. We can do more with somebody who's under 65 or 70 for percentages and so forth. We can still do plenty of things. We have a lot of clients in the 70 to 80 range, and even some in the 80, 85, but much beyond 85, I'm very limited on the alts world. Okay. I'm often more working with families. If I'm in the 80 plus range, I might be talking with a father and a mother or mother, but I'm often involving kids in those decisions.
Estate planning kind of stuff, John?
Yeah, I'm not an attorney, not a CPA, but we are very familiar with a lot of estate planning needs. We can work with trust accounts, do a lot of trust investments in trust accounts, in LLCs, you name it, individual, joint, IRAs, you name it, we've seen it.
All right. And then to kind of wrap it up here, John, we talked about the Delaware statutory trust a lot. Are there, let's say, 2 other products that you have that kind of shine that you want to let us know about? That just would be a great investment, whether it's a REIT, whether it's from the oil things, whether it's something. What's there today that you really would like people to know about?
Wow. We do a lot of different things with options. But that will take way longer than we have time for. I've trained options. I did them on my own account. I traded my own account for a number of years. But we have a lot of investments that utilize options. Why do we do that? We can invest in the markets, but have less risk in the market. Is a short way to describe that. We do that with structured products. We do that with other sophisticated investments, so that we can participate in the market but not be correlated or have less risk or greater return. So that's one thing. And we do that as an alternative to many kinds of annuities as well. We can do that with less expensive products. We can do it with the same advisory account and so forth. The other one is our non-accredited real estate, the stuff that we're doing all day long in our advisory accounts. And if I can cheat a little and describe two products briefly, the REIT, Real Estate Investment Trust, has evolved tremendously in the last 5 and 10 years. They were all, the non-traded REITs used to be all buy and hold for 5 to 10 years or more. Today, many of them offer monthly liquidity. I can put them in an advisory account. They're bigger and continuing to raise money, so they're less risk of having, too small of an offering. We've done a lot of real estate in apartments and warehouses. Those are our biggest categories, very recession resistant, very inflation resistant. Our interval funds are a fund of funds. So think of it like a real estate mutual fund, except between 70 to 98% of the assets are actually held in those institutional real estate funds. The stuff that we talked about up front, you need $1 million to $10 million to invest in those funds. You need $2,500 to invest in an interval fund. And those have to keep their liquidity open every quarter. They cannot shut that liquidity off. That's an investment that the REITs I described are 70, 72, 50. They have suitability because the liquidity might be shut off. The interval funds, the liquidity cannot be shut off. So I have clients who don't even meet those requirements who are able to invest a bit in the interval funds. And like I said, what's the overall goal? The overall goal is to have our clients able to invest more like the institution funds out there.
Got
it. If our client who has a couple $100,000 or a few $1 million can invest like a pension fund with $100 million and have more options and investments available to them that wouldn't normally be available to them. That's our specialty. It says on the business card, independent financial planning firm specializing in non-stock market investments. We really specialize in institutional or institution-like investments for the normal person. That's my story. I'm sticking to it.
John, we've hit the tip of the iceberg, and you really piqued my interest there with the options and stuff. So we might have to have you back on another webinar and spend 30 to 40 minutes and just focus in on a couple of those investments. You want to do that sometime?
Absolutely. I mean, time just flew by. I thought we barely got into anything.
This was kind of the overview chat, and it was very interesting. Your information is going to be on the screen for people to give a call, but for our webinar audience, John, you want to just say how they can get a hold of you if they wanted to chat with you about any of this stuff?
Sure. You look up our website, McKeonFinancial.com. It's spelled McKeon. So McKeon Financial is our website. It's got a lot of stuff there. Our number, 360-652-4244. If this was the radio, again, that's 360-652-4244.
Another career buddy in there, I can tell, John. You sounding good.
I tell you. But yeah, just give us a call. We'd be happy to chat. One of the things, we do the appointments with no expectation. It's easy to say, hard to accomplish, but that's been our goal for many years. When somebody calls, we'll talk. I'll ask a bunch of questions, and ask what are your top of mind thoughts, ideas, questions, concerns, just what's on your mind. Let me get on your page quickly and listen and evaluate and see whether or not we can help you. And approach that with no expectation of getting a sale or doing something. If I can talk you out of something that doesn't make sense, great. If you want to do business with us, that's fantastic. We're happy for that, but we want to honor our clients or potential clients first and their needs long before we do any business with them. So that's our story.
That in itself is a fine goal, John. Absolutely true. That's kind of why we John and I fit together. We kind of have the same business acumen with our clients. We want to do the best for them And as you can tell, guys, John's all about education. You know that we're all about education. We could let people learn what they need to learn so they can make informed decisions and smart ones with some good advice. John McKeon of McKeon Financial, thanks for joining us today. That was very interesting, John. We'll have to have you back and get a little deeper into the weeds here, I think, though.
Sounds like a plan. Happy
All
to.
right. Thanks, John.
Okay.